Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is May 5th of 2022. Happy Cinco de Mayo Day. And if you saw the markets today, you and I, we all might need a margarita. Now, markets sold off and they were down today off of a big up day yesterday. Now, why were they up yesterday and down today? Well, it was really simple. The Federal Reserve Chairman Jerome Powell in his press conference said, hey, basically, we're going to raise interest rates in the future, but not as much. Yesterday, they raised them by 50 basis points. And he also said the future, we're looking at 50s, not 75. Markets were pricing in higher highs in terms of, let's say, would they raise interest rates? Now, the market itself basically said, wait a minute, not so fast. We actually got some employment data today that showed that the unit labor cost was up 11.6% today, which just means that inflation is entrenched now with regards to balance sheets. Balance sheets by way of small business owners trying to retain employees, trying to attract employees at higher wages, and large companies doing just the same. That being said, I talked about this earlier this week on Tuesday, so if you tuned in, wonderful. If you haven't, here's a quick recap. Markets go up by earnings, and the earnings picture right now, we're in the middle of earnings season. And essentially, 75 at the time on Tuesday, 75 of the 500 S&P 500 companies reported earnings, and the earnings on average, the estimate was about 7.3% in terms of year-over-year growth. We're at a 10% right now. The actual is a 10%. So companies are reporting better than expected top-line earnings. Now, what the real question is, why are markets going down? Because of this dirty word inflation. Again, wage inflation. If wages go up, it's going to compress basically the bottom line, essentially. Now, why do we have that problem? Well, essentially right now, if we look at the job openings, that's the JOLT report, versus those that are available to work, it's a 2-to-1 ratio. So 2 jobs for every 1 worker in the U.S. economy right now. That's what the strain is. That's the tug of war right now. And that's what's pushing wage inflation higher. Now, Federal Reserve Chairman yesterday said, hey, listen, he's going to raise interest rates to the point where he's not going to break anything. Don't worry. He's just going to navigate and engineer a soft-ish landing. That's a kind of an interesting word because I don't think we've ever heard it before. And it kind of says, hey, wait a minute, markets are kind of calling his bluff today saying, what the hell does softish mean, right? So the Federal Reserve has a lot of work to do. And even though they didn't do what they did a great job yesterday, there's a lot more work that needs to be done on the go-forward basis. Now, again, earnings underneath all of this basically are the ones that drive the market. And how are they doing? Well, in 2021, the S&P earnings, it was a 208 in terms of you take all the earnings together, about 208. The estimate is 227. So we've got an increase here for the earnings estimate. As I said, we have evidence, empirical evidence, that corporations are reporting higher growth rates. They are earning. So why is the market not up? Essentially, in 2023, earnings are up to 250. These are estimates. Well, essentially, it's, again, what we have is an overheated labor market. Again, we talked about the unit labor cost. Now, at the end of the day, you really have to say, hey, listen, let's tune out the news. Let's see what happened structurally. The market's retested, especially the NASDAQ, the triple Qs, retested an earlier low at the 309 basis, and we bounced. So we didn't accelerate negatively into the close. We actually had the 3 indices, the Dow, S&P, and the NASDAQ, actually bounce today. Tomorrow will be a different story, right? Each day is a different story. But we talked about this with our clients early on this year. We said, hey, listen, be prepared for heightened volatility. We have some cash to deploy. We're being patient. We know the economy is extremely strong, but we're going to choose our spots because the volatility is here to stay, as evidenced by yesterday, today. We don't know what tomorrow brings, but I will tell you this, we're looking well into next week. What we're going to pay attention to, what markets are really waiting for, is next Wednesday, the CPI report, which is the Consumer Price Index, right? Last month, we had 8.5%. That's at 8.5% in terms of inflation rate. Let's see if that's sustainable. We'll see if it comes down a little bit. If it comes down a little bit, markets just double tested the bottom today and we bounced. If we hold that tomorrow and Friday and we get to Wednesday, we could see potentially, not know for sure, but we could see a nice little rally next week if we get a number that's 8.5% or less. So we're somewhere in that ballpark. So that shows that inflation is coming down. What you and I spend our money on, essentially there's some relief there. Could that be a case? Well, right now, the ISM data, the data that we're looking at outside the U.S., yes, there's recession. Even though the Bank of England raising interest rate right now, they're actually fearing recession right now, and that's across the globe. That data is showing that those economies are shrinking just a little bit. So we're at the tip of the iceberg. We potentially could be at the height of maybe that inflation number. Now, if we're not, all bets are off. Markets will then drift lower. lower, and we could see lower lows to come. So we got to get there. We've got some cash to deploy. There's a lot of sectors that we're putting money to work on and rebalancing portfolios. And essentially, every day we're just working our way through the rebalancing and staying on top of our clients' portfolios and the market itself. So there's always a value somewhere. And essentially, at the same time, who sees value right now? Well, it's Warren Buffett. I talked about him on a Tuesday, and essentially we had the, obviously annual meeting of Berkshire Hathaway this past weekend, and he basically reported that he had $140 billion in cash on the balance sheet to start the year, and now he's got $100 billion, 104 to be exact at this moment. Who knows, it's even less, but what that tells us is he's finding value in this market. He's putting money to work because he knows the earnings are here. He knows the growth rate is there. And what's an inflation hedge? Well, companies that pay dividends are inflation hedges because they're going to grow out of and stay ahead of inflation. So what would Warren Buffett do? WWWDB or BD. This is the type of market he's buying when everyone else is selling. So our clients in this case scenario don't need to sell, and we're looking at interesting opportunities. So as markets are at lows, who knows where we go from here, but what would Warren Buffett do? And he's continuing to buy. So we're taking a look at what's coming our way, but staying on top of the markets nevertheless. Now, don't forget, it's Cinco de Mayo. Happy Margarita Day. Take care. Have a good one.